Nick, last time we talked about basics like top line, bottom line, EBITDA, margins, and guidance. I actually listened to a real earnings call after that, but I stumbled when they mentioned things like gross margins, one-off items, and free cash flow. Can we dive into those today?
Absolutely. That's a great step forward. Listening to actual calls is the best practice. Let's tackle 5 new terms that often reveal a lot about how a company is really performing: gross margin, one-off items, operating leverage, Capex, and free cash flow. First, gross margin. Remember we talked about margins last time as a percentage of revenue that turns into profit? Gross margin is more specific. It's calculated as revenue minus cost of goods sold, divided by revenue.
So it shows how much profit a company makes after covering just the direct costs of making its products?
Exactly. It doesn't include marketing, salaries, or rent, just production costs. High gross margins usually mean a company has strong pricing power or efficient operations. For example, software companies often have gross margins above 70%, while retail might be closer to 20 to 30%.
I've also heard management say something like, excluding one-off items, profits would have been higher. What does that mean?
Good observation. One-off items are unusual gains or expenses that are not expected to recur regularly. For example, selling a piece of land or paying a huge legal fine. Analysts often exclude these to get a clearer picture of the underlying business performance.
So it's like saying, don't judge us by this unusual event, focus on the core business.
Exactly. But remember, sometimes companies overuse this excuse, so investors need to be cautious.
Okay, next term, operating leverage. Sounds complex.
It's actually simpler than it sounds. Operating leverage refers to how much a company's profits can grow when revenue increases. If a company has high fixed costs, once revenue rises, profits grow disproportionately faster.
Like a lever effect?
Exactly. Imagine a software company. After covering its fixed costs like servers and salaries, every new sale adds directly to profit. That's high operating leverage. On the other hand, a factory with lots of variable costs has lower leverage.
Capex is another term I hear all the time.
Right. Capex stands for capital expenditure. This is the money a company spends to buy or upgrade assets like factories, machinery, or technology infrastructure. Think of it as long-term investment into the business.
So when a company says, we're increasing Capex, it means they're spending more on future growth?
Exactly. But investors also watch how efficiently Capex translates into revenue growth. Heavy Capex with little payoff can be a red flag.
Last one, free cash flow. This one really confuses me.
Fair point. Free cash flow is the actual cash a company generates after paying for all operating expenses and capital expenditures. In other words, it's the money left over that can be used to pay dividends, buy back shares, or reduce debt.
So unlike profit, which can be influenced by accounting, free cash flow shows real money left in the bank.
Exactly. That's why many serious investors focus on free cash flow. A company might show profits on paper, but weak cash flows in reality, which is a warning sign.
Got it. Today we decoded gross margin, one-off items, operating leverage, Capex, and free cash flow. That feels like peeling another layer deeper into how businesses operate.
Exactly. Each of these terms helps you move beyond just revenue and profit and into the quality of a company's performance. Next time, we'll go even further into concepts investors use to test sustainability and risk.
Looking forward to it.
Disclaimer. This podcast is for informational purposes only and does not constitute financial advice. Always do your own research or consult a professional before making investment decisions.